So there we go. Let me share the screen. And just, I know that Antonio, you said you're kind of just getting started. And so for anyone watching this, whether you guys here live or on the replay, kind of my intention was to give kind of like an outline of some of the possibilities that exist right now in crypto, and then walk you through a little bit of the tactical stuff as well. So anytime we're looking at investment opportunities, obviously you want like a big picture strategy. You want to know like what moves you're going to make, what part of crypto that you want to participate in. And then after that, then obviously, yes, there are tactics, there are buttons that you need to click to make those investments. Sorry, give me 1 second. I need to close this other window, otherwise it's going to be popping up stuff constantly. There we go. All right, cool. So in terms of what we do in the mastermind strategic approach, I'll just go over this kind of briefly. In crypto, there's a lot of different possibilities, right? There is day trading, potentially very lucrative. Personally, I don't participate in that anymore. I used to do a lot of that. It is higher risk, unless you like really know what you're doing, and it's high time commitment. So there's I call that high maintenance. Basically meaning like there's gonna be a big commitment on your part to like show up very frequently and do stuff and make things happen. You've probably heard about mining. Again, another possibility. I don't teach mining. I don't do any mining personally. But I know a few people, even some people in the mastermind, who also participate in crypto mining, whether that be Bitcoin or some of the other assets that are being released in that manner. And then on top of that, we've got DeFi. Okay, DeFi typically refers to all of the tools that are available to us in the world of decentralized finance. One of those tools is called liquidity provision. And you may have heard phrases like yield farming or staking or something kind of in that realm. The idea here is that in the world of decentralized finance, you, as the average investor, you can provide liquidity, you can add value to the entire ecosystem of decentralized finance. And for doing so, you get rewarded. Now, the first question most people have is like, well, how? Like, what does that mean? How does that even work? Well, if we're going to break it down super, super basic, if you had two assets and it's not showing up here. There they are. You have two assets that people want to trade. Okay, I just put these random symbols here. It doesn't matter what. It could be Bitcoin and ETH. It could be Arbitrum and USDC. Doesn't matter what it is. Any two assets that people want to trade. You need a pool inside of which people can make that swap. So if I'm a trader, I'm going to put one asset in and I'm going to pull a different asset out. In DeFi, you need an established liquidity pool in order to make that happen. So if I'm a liquidity provider, I put these two assets together and they create what's called LP token, right? Just liquidity pool, LP token. So your new LP token is basically the representative token that you are providing both assets in a, initially you provide them in equal measure to this pool so that other people can transact. I mean, well, you can transact too. It's a pool. Anyone can make trade in it. So the idea here is that if someone wants to launch a DEX which means a decentralized exchange platform, okay, as opposed to centralized exchanges, right? Coinbase, KuCoin, crypto.com, Uphold. These are like the big players. These are established centralized exchanges. They have a different model, okay? But with decentralized exchanges, they operate with what they call an AMM, an automated market maker, okay? You don't have to know all of these like right off the bat. I'm just kind of mentioning them in case you want to look this stuff up afterwards, right? Like you could go to YouTube today and look up crypto automated market maker, and you'd probably get like 80 hours of educational video. It's all just gonna be theory, but that's fine. It's a way to start to understand what's going on here. So the automated market maker uh, needs liquidity, and anyone who has a DEX, a decentralized exchange platform, wants their DEX to be safe, fast, and reliable for anyone who wants to transact on that exchange platform. Because the safer, faster, more reliable it is, the more users it attracts. And these DEXs, well, let me go back up. These DEXs make their money with trading fees. So even if it's tiny, tiny amounts, let's say I swap Bitcoin for ETH and I'm on, I don't know, let's say it's the Ethereum network, it's probably gonna be a little bit more on the Ethereum network. And that transaction costs me $3. Let's say, just make up a number, it's $3. Well, that $3, number one, the DEX is going to get some of that because that's their profit model. They're making money by providing a platform upon which other people can trade various assets in crypto. So they get some trading fees, but also if you're providing LP, if you are a liquidity provider, you get a percentage of the trading fees. So the amount that you get is determined by how many other people are also participating in that liquidity pool, because the fees are divided out amongst all the liquidity providers, depending on what percentage of liquidity that they're providing. And also it's dependent on the trading volume. So if you get into a liquidity pair that isn't traded very frequently, it's not going to provide you with a ton of liquidity or a ton of fees at the end of the day. On the flip side, if you get into a pair that is heavily traded and a not overly saturated pool, then you are going to profit from that because you're going to get a portion of those trading fees. So all that to say, the only reason I wanted to preface everything with that, because the strategy inside the mastermind consists of 3 tiers, okay? The first tier is your primary assets. That is your liquidity pools, okay? Then you will yield secondary assets. That will be your yield from farming and your trading fees, okay? That's your trading fees by being a liquidity provider. Then you accumulate those and you can single stake for tertiary assets, okay? Then the idea here is to accumulate these long-term, filter them back through, increase your LP to increase your yield and trading fees to increase what you get from staking. So it's a multi-layered approach. The idea, of course, being that rather than just buy and hold, which is one profit opportunity, and by the way, nothing wrong with that. I'm not putting that down. Like that's critical. That's core to this whole thing. But if you do it this other way, where you're actually a little more strategic in how this happens, you're going to create 6 profit opportunities. And I say opportunity because it's investing, right? It's crypto. Like everything could tank to 0 tomorrow. That's just the risk we take by participating in this. I don't think it's going to, but that's the reality of it. So a profit opportunity means I could buy low and sell high. And that would be an opportunity to earn, especially if I'm timing the market right and selling at the appropriate time. Or I could create multiple profit opportunities. But the foundation of it all is understanding the process of providing liquidity. Because this is one way to do it. This is a loop, right? Where your accumulated profits filter back into each other. You can also create shorter loops. I could go liquidity provision, earn some trading fees, filter them right back in. Okay. Today, when we get to tactical stuff, I am going to show you an example of this shorter loop, only because for the sake of illustration, it's just a little bit simpler to show you. But just acknowledge that there are multiple ways to implement this strategy. And there are multiple ways to implement depending on your risk profile. So there's liquidity provision that is a broad range. And there's liquidity provision that they call concentrated liquidity, which is a much smaller range where you can potentially make higher fees, but the risk profile goes up a little bit. So the idea here is if this is my risk profile, if this is like the, yeah, Ken, do you want to say something?
Yeah.
I think he's somebody leaked the information.
All right. Well, I think Ken is talking to someone else. So if this is my risk profile, and this is the high risk up here, and this is the low risk, this is where it gets into like my opinion, okay? Because there's a lot of different ways to play in crypto. A lot of people like to play over here. A lot of people like, I want a 100x moonshot because that's super fun. Put in $100 and 3 days later you get back 10 grand. That's super fun. It's gambling, right? It's just like pull the lever, woo. And for every 100x that you win, you're probably gonna lose a lot of other gambles too. But to be fair, I know people that do this and they make a lot of money doing it. Again, back to my opinion, I believe, and this is the approach that I advocate for in the Mastermind, that we want to play as close to the lowest end of the risk spectrum as we possibly can. Okay. The lowest low, like all the way over here, that would be like I'm pairing stable coin or I'm staking stable coins, right? Dollar for dollar, stable coin tied to the peg to the dollar. I'm staking stable coin and I'm earning 5% a year or something like that. That would be your lowest risk in the world of crypto. I'm saying, hey, we can play here, maybe even here, but on the very, very lower end of the risk spectrum. And you can still reasonably, not unreasonably, you can still reasonably return 50 to 100% per year on average. Okay. And compounded over 8, 10, 12 years, whatever your time horizon is, that ends up being extremely, extremely lucrative if you have the patience to stay in that space, to stay here and not sort of start to trickle over into the higher risk space where there's much higher probability that you will take big hits along the way. And so, I mean, it's the old, it's the Warren Buffett quote, right? The first rule of investing, don't lose money. That's kind of the premise here is like, let's take that principle from traditional finance and apply it to crypto and say, let's play on the low end of the risk spectrum, because even if you can just avoid loss and avoid ruin and get reasonable gains over time, you're already going to outperform probably 80 to 90% of the crypto investors that are out there. Because when you see people posting screenshots of like, oh, look at my 50x, oh, look at my 100x, they're not posting the screenshot of the other 50 coins that went to zero that they lost on. So even though people are getting these 100x's and these big gains here and there, they're not getting that on every single trade that they make. That would be ludicrous. And then they'd probably be teaching people how to do it. Okay, so let's talk tactical here. And then, like I said before, I mean, this is kind of an impromptu session. We can open it up for questions if you guys have anything specific that you want to talk about. But the tactical example that I want to show you today, first of all, it's a tool called Aperture. Aperture Finance is, I guess you could call it a liquidity management tool. It's basically just a tool that already exists. It's not mine. I don't have any part in it. I've just stumbled upon it and I like it a lot. It's very useful. And it allows you to manage your liquidity positions in a really friendly user interface. So what I'm going to show you today is a pair that I actually just did this because I wanted to do a demo for the Mastermind as well. I just did it about a little over 24 hours ago. I created a pair of Arbitrum and USDC. Now, if you know a little bit about crypto and what's going on, there's these networks, right? There's these separate blockchains. There's Ethereum, there's Phantom Opera, there's Polygon, there's Cardano. There's all these different networks upon which transactions take place, upon which things happen. Arbitrum is one of those networks, but it kind of piggybacks off of the Ethereum network. So it's a way to deal with some great Ethereum-based assets, but with much, much, much cheaper fees. So what we have here is a classic pair. And again, in the Mastermind, these are the types of pairs that we often work with because you're talking about a network token paired with a stable coin. So the stable coin, the USDC, pegged to the dollar, that's not going to fluctuate up or down. It's always worth $1. Whereas Arbitrum, the other asset, will fluctuate. So by pairing these two up, on the one hand, you might say, well, hold on, Brandon, if I have $1,000 and I'm going to put half of it, 500 into Arbitrum and half into a stable coin, wouldn't there be more upside if I just bought $1,000 worth of Arbitrum and held that long term for 10 years and then cashed out? Yes and no. In one sense, maybe there's more potential upside, but again, you run a different kind of risk. And in this case, you're risking losing out on all of those trading fees that you could have accumulated and then earned additional assets from. You're missing out on those in the meantime because you're thinking, oh, the one asset has a higher potential upside. The best metaphor that I can come up with that I think is just super simple and straightforward is like if I buy a house, that's my asset, and then I just wait 20 years and then I sell it. So let's say I bought it for 1 million and then I sold it for 2.5 million because it's been 20 years and, inflation and all that good stuff. And I sell it for 2.5 million. I go, hey, great. I made 1.5 million. Great. Pay my capital gains tax, call it good. Or during those 20 years, I could rent that house out and then I would have 20 times 12. What is that? 240? 240 times whatever I'm charging for rent. So if I charge 2,500, so whatever that comes out to, it's what is that, another 500,000 or so. The idea is if I'm going to hold on to the asset anyway, I might as well turn it into a productive asset rather than a non-productive asset. So the metaphor here is a piece of property can be a productive asset if it produces income while you hold it, or it can be an unproductive asset if it just sits there and does nothing. You're still going to make some money off of it because of the appreciation, but you could have made much, much more if you made it a productive asset. That's what we are doing in effect with crypto. We're saying, I'm going to buy these assets, and instead of just hodl, hold it for 10 years and then sell it, you make money, by the way, doing that. You could just buy $10,000 worth of Bitcoin and sell it 20 years later, and you'd probably, I don't know, 6, 7, 8x your money over the course of that time. But it's like, while you're doing that, why not make it productive, and why not stack your profit opportunities onto each other? Cool. I'll pause. Do you guys have any comments or questions before I dive into some of the tactical stuff here? Do, 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 do. All right. Well, I'll take that as a no. If you have anything else, feel free to always jump in if you need to. Let me open up Richard Finance. And I've already built this one, so we're not going to go through like all of the little button clicking here to put it together. But I wanted to show you just kind of the what's possible with this kind of stuff. I probably should have waited to harvest the fees. I harvested earlier today. Like I said, this was impromptu. I didn't know I was going to do this. Okay, so what we've got here is Aperture Finance. Okay, again, this is one tool among many. In the world of crypto, I mean, there's a lot of illegitimate, terrible tools out there that'll scam you and take your money. But if you know how to navigate the crypto sphere here, you can find the legit tools that are really, really well. So what Aperture does is it takes Uniswap, which is one of the biggest DEX exchange platforms in all of crypto, but also on the Ethereum network. And it uses some of their features, but then adds to it to make it easier to navigate. So I'm on the Arbitrum chain here. You can see I can select many different networks that this tool can leverage. If I wanted to transact on the Optimism network, for example, I could do that. If I wanted to pair Optimism with USDT or something like that, I could go on to Optimism network and make that happen. So what I'm going to do is liquidity management and let that load. Okay, so this is my position. This started at about $900, okay? Meaning that the price of Arbitrum went down a little bit in the last day. That's okay. Prices fluctuate. I'm less concerned with the value here because I know that over time, that is going to gradually rise. What I'm concerned with is these fees here, okay? So right now, I've created this liquidity position. The weight is 66% Arbitrum to 34% USDC. And I've set my range here to be, the range means the range inside of which you will earn fees as a liquidity provider. So if I fall out of range, it means I'm going to stop earning fees. And all I have to do, though, is then rebalance that range, okay? So basically, this is saying since I harvested, which was, I don't know, about an hour ago or so, I've earned about 20 cents in fees. When I came back earlier to harvest this, it was just over $6. Now, at first you might think like, oh, $6, Brandon, like, oh, that's so awesome, you know. But think about it. If I started with about 900, and granted, it's down to 865. But if I do not, if I do $6 divided by the initial 900 that I put in, that is about 0.65%. So it's less than 1%, but 0.65% for one day. Even if I didn't compound, let's just do 0.5%. If I said 0.5% and I compounded it every single day for a year, I would end up with 6 times what I put in 1 year. Now, that's assuming the volume stays constant, right? Which I would argue that probably over the course of the next 12 months, the volume for all of crypto is going to increase dramatically. Number one, because we're coming up on the Bitcoin halving event here in April, so a lot more money is going to be pouring in. But number two, with all the talk of like ETFs and institutional investors and all this stuff, there's a ton of new money, which then attracts more retail investors, which then attracts more just volume, more trading. So again, assuming that the volume just stays consistent, this is a 6x play. Now let's be conservative though. Let's say I didn't compound every day, which is literally it's one click. It's click, reinvest. There it goes, right? That's literally all I have to click is reinvest. It takes those $6, it put them back into the liquidity pool. Even if I didn't do that, even if I just forgot about this and let it accumulate for a year, so I wouldn't get the compounded daily gain, but I would get just a linear gain at a 0.5% of that initial investment every single day. I would be getting about $6 return times 365. So if I just did it even, again, just keeping the estimate conservative, 6 times 365, that's 2,190 divided by the initial 900. That's like a 2.43x. Okay, so that's like a little over 300%. Wait, is that right? That doesn't sound right. 0.5% should have been a total of, I probably punched something in wrong here. Anyway, 0.5% a day should have been times 365 days should have been about 180%. Yeah, that is right. Because that would be about 2.8. Okay, sorry, I confused myself. So anyway, all this to say, is this a guarantee that you're going to get that money if you do this one play with Arbitrum USDC? No, of course not. But it's a pretty accurate way to project what the potential is. So let's say you had 20,000 that you wanted to put into liquidity pools and farming and some of this stuff. And you go, okay, I've got 20,000. I'm going to build 4 different positions. They're going to be $5,000 each, and 2 of them will be paired with a stable coin to keep things just like, again, lower risk, maybe lower potential upside, but still lower upside. This is potentially a 2 to 6x on the year. That's the low upside. And then I could put 2 into not like super aggressive, but like slightly more aggressive returns over time. And then I would basically just implement that. I would check back in on some of these daily for like a click. Again, it's like 30 seconds to check in, or I would check in weekly. I tell the folks in the mastermind, like, look, if you want low maintenance, we can build this so you're doing 5 to 10 minutes a week at the most. You just check in, reinvest if you want to. Arshad has entered the waiting room. Cool. And then collect your fees, compound. It's just like the amount of clicking that you have to do is very minimal. Arshad, welcome. We're just kind of taking a look at some liquidity pools here and a tool called Aperture Finance, which is available in the world of decentralized finance. How are you?
Good. How are you?
I am doing great. So anyway, all that to say, the 20,000, you have 20,000, build 4 different pools, 5,000 into each position. And then the kicker here, the trick is, let me pull this back over. Number 1, and it might sound too simple because it is, patience. Number 2, consistency. And number 3, staying away from shiny object syndrome, which is what happens most of the time in crypto, right? You start to see some gains. You go, whoa, this is so great. Like, let me see what else is out there. And you start getting into all the other minutiae and you get distracted from the fundamentals. I'm telling you, all you need is a clear strategy and then consistent implementation of that strategy. That's the idea behind the mastermind, is keeping everyone on track. So we're dealing with LP pairs. The essentials, okay? So you got a network token plus another network token. Okay, an example of this could be, there's lots of examples, but what if I said, oh, I want to pair Arbitrum with ETH, or maybe like a wrapped Ether on the Arbitrum network or something like that. Great. What a great pair. Like those are two assets that are more than likely going to appreciate significantly over the next 12 to 18 months. Okay. So I'm less concerned about like the weekly or monthly volatility. I'm more concerned about like just the general trajectory of these assets, which, as kind of a side note, you'll get often people ask me like, well, what's the weekly returns? What's the monthly returns? And I'm like, I could say, well, yes, look, here's something that gave me a daily return of 0.5%. I don't know that it's going to stay at a 0.5% indefinitely, but I'm less concerned with the weekly and monthly returns. I'm more concerned with the total yearly average returns over time. And again, as simple and straightforward as that sounds, you might go, duh, Brandon, yeah, I'm all about that. But proof is in the pudding, right? Like I have a lot of people that will tell me they're patient, that they want to do it this way, but then they're actually more about like, how can I make a whole bunch of money right now in the next month and then like start getting a paycheck from it immediately. Well, yeah, if you got 500 grand in capital laying around, you could create a pretty nice passive income stream like immediately with ultra low risk assets and you'd be set. Most new investors in crypto aren't starting from that place. And even if they were, don't necessarily feel comfortable putting that much in all at once. They'd rather like slowly DCA in over time. Okay, so sorry, that was a tangent. Then we've got network plus DEX. DEX is your decentralized exchange platform. Example of this would be, okay, I've got the BNB token, which is the native token of the BNB Smart Chain Network. And I'm going to pair that with Cake. Cake is the native token of PancakeSwap, which is one of the largest decentralized exchange platforms. Originally, it was just on the BNB chain. Now it's actually expanded to other chains, other networks as well. So again, these are examples of reliable pairs. Then we could say network plus stablecoin. We just did that actually. That was Arbitrum plus USDC. Anytime you've got the network token plus a stablecoin, in my opinion, that's a very, very strong play. It also makes it a little bit easier if you want to participate in concentrated liquidity plays, which is what that example that I showed you was, because the stablecoin is stable. So adjusting your range as things evolve is only dependent on the one variable, which would be the network token. Now, between those, we could create other combinations. Okay, I could say DEX token plus another DEX token. I could say stablecoin plus another stablecoin. I could kind of play around with not only these categories of projects, but which project that I'm going to plug into it. And the largest, safest I could do DEX plus a stablecoin. I think I might have said that one already. This would be an example. This would be Solana plus Ray, which is the native token of Radium, which is one of the bigger and more established exchange platforms on the Solana blockchain. The point is, if you stick to, I guess I'll call them blue chips, that's fine. It's kind of an outplayed term. But if you stick to these types of projects, these categories, you tend to be pretty safe as long as you're not picking like a stable coin that just launched yesterday, right? I'm talking the stable coins that have been around for a while. Could they all implode on themselves at any time? Sure, any of this could. But in terms of staying as close to the low end of the risk spectrum, it's never going to be zero risk. Let's not kid ourselves. There's always going to be some risk involved, but I want to stay further towards this end of the spectrum where possible. And a big part of that is project selection. Which projects do I actually invest in? And in my opinion, the reason those are so great and reliable is because they represent, did I spell that right? Infrastructure. They represent the infrastructure of crypto, meaning decentralized exchange platforms You need blockchains upon which transactions happen. You need decentralized exchange platforms that are built upon those networks. You need stable coins for traders, basically, to go in and out of positions without having to convert all the way back to cash. And then you can rinse and repeat, basically. So, okay, again, I'll stop here. Arshad, I know you just joined us, but part of the premise here was this was just an impromptu session. I just thought, hey, let me jump on a Zoom and chat with people who need or want some help. And then I open it up for questions as well. So if you had anything specifically that you wanted to chat about today, a question you wanted to ask, you can drop it in the chat, or you can just take yourself off mute. We've only got 4 of us, including me, here live. So you can take it off mute and ask away. And that's for anyone, by the way, not just Arshad. Okay.
So can you talk about the rebalancing a little bit? Why is that needed? How does it get out of balance, I guess?
Sure. Let me go back to, and I'll answer Arshad's question here too. He asked, what were you covering about aperture? You're about to see. So this is actually good. Both questions kind of overlap with each other. We were basically saying, hey, what does it look like when you have a concentrated liquidity position? And then what do you do with that and how do you manage that? Uniswap v3 is one place to go for concentrated liquidity, but the user interface, even though they kind of were the OGs with concentrated liquidity, the user interface on Uniswap is still kind of janky. It's getting better, but it's still kind of janky. And so in my opinion, Aperture helps make the user interface a little more streamlined. So, okay, Stephen, you were asking, how does it get out of balance? So initially, when you create your position, you choose a range, okay? And I've already rebalanced this, but let's pretend this was my original range. I said, I want to set my range from 1.58 to 1.89. Now, this makes it a little bit easier because I'm dealing with a stable coin, which is related to a dollar, and our brains tend to think about dollars. So basically what I'm looking at is this is the price of Arbitrum from 1.58 to 1.89. Current market price is 1.69. When I first took position, I think it was 1.84 or something around there. So that it's dipped a little bit. That's why the total liquidity pair also dipped a little bit along with it, because one of the assets went down a little bit in the meantime. When you get into other positions like ETH and Bitcoin, these numbers can be a little bit trickier to navigate because of they're so far apart in terms of dollar value, and they kind of like rise and fall, not directly correlated, but like mildly correlated with each other. So, but anyway, the idea here is this is my range. And the closer, and right now, here's my distribution, right? 66% Arbitrum, 34% USDC. The closer I get to the lower end of this range, the more my liquidity pool, my position will be weighted with Arbitrum. The closer I get to the max end of this range, the more my position will be weighted towards USDC. Now, if I fall out of range and I don't reposition, I don't rebalance, I mean, if Arbitrum went down to 1.56, like all of a sudden, the only thing that, like, it's not like anything explodes, it's just that I stop earning fees because I'm only providing liquidity as long as we stay in this range. Previously, with liquidity provision, before the function of concentrated liquidity came out, previously, you would just say, I'm providing for the whole range. So USDC is $1, so it's always $1, but Arbitrum all the way from 0 to infinity. Well, there's not, that's what this graph actually represents. There's not a whole lot of price action happening at 0. And right now with where Arbitrum's at, basically anything above $2, like there's probably nothing in the near future going to happen there. So you've got this massive range of liquidity, but the trades are only happening in this very small finite range. So that's what concentrated liquidity does. It says, okay, you're providing liquidity only for this range, and you only get paid a portion of trading fees as a liquidity provider when trades happen within this range. That's really all it's saying. So the risk would be if I set the range too narrow and I don't monitor it. So this is not the lowest maintenance approach. It's like slightly more maintenance because you do have to pay attention to it. Just check in every day or two. If I set the range really tight because I thought, oh, then I get a really good return. I get tons of trading fees, but then I fall out of that range the next day and I don't check it for a month. Nothing exploded. I'm still probably going to have my original liquidity that I put in, but I didn't get any trading fees that whole time. So I was providing liquidity and I wasn't getting compensated for it. So that's all it means. And in the case of a stablecoin play, if I fall out of range above where I bought Arbitrum, yeah, no harm, no foul, right? Because the stable coin is stable. And then basically I get a little bit profit from the Arbitrum going up in value. I just don't get the trading fees. Flip side is if half my pair is stablecoin and Arbitrum tanks to like $1, not only am I hanging out, not earning trading fees, but if I want to exit that position and then get a new position, I would have to take a slight loss because Arbitrum is now lower than when I originally bought it. So the idea is pick a wide enough range that you think it's probably going to stay within that range for at least the next week or so. And the way you do that is you just go coin market cap. Or I mean, there's a ton of these sites out there, right? Basically any chart, Dex Screener, Dex Tools, Coin Market Cap, CoinGecko, all that stuff. I would check on Arbitrum. And you don't have to like do a ton of research on this kind of stuff. It's more just like, okay, let me check the last month. And I go, okay, so for the last month, the low was down here at 1.3. The high was up here somewhere about 2.3. Well, if I wanted to play it really safe, I would set my range at 1.3 to 2.3. I'd probably earn less total fees. I probably wouldn't be getting that 0.5% that I was telling you guys about before, but I wouldn't have to check on it, and I probably wouldn't have to worry about falling out of range. Then I can go back to the whole year if I'm just curious about this asset overall, and I go, wow, okay, so back in April of 23, not quite a year ago, it was at 1.7. Today it's at 1.68. All right. Well, and then the low was down here at 0.78. Probably not going to go that low again. That was October. I would imagine it wouldn't go back there. I mean, it could, you never know. But now we're on this kind of, again, just general upward trajectory. And I could even go to the history of the entire app. Maybe that is the history. Maybe it only goes back that far. So anyway, that's the point, is that I can take a look at what's happening generally with this price action and then go, you know what, I feel comfortable with this range. And if it starts to fall out, because I think my previous minimum was like 1.64. And when I went to check on it today, I was like, oh, well, the market price is 1.68. I'm going to rebalance that. So I just rebalanced it a little bit so I don't fall out of range. And again, I've just been sitting here. I mean, that's not much, 20 cents. Well, I should. Here, let me refresh it. There you go. Since the meeting started, I earned 10 cents. Yes. So, but that's what's cool though about Aperture as a tool. The user interface is super friendly. It just like it lays out all your stats there for you, and you can play around with all the like little variables and things that you need to mess with. Did that answer your question, or like do you have a follow-up, or did that help, I guess?
Yeah, that helped. I guess how much does it change when you narrow the range? Like what kind of percentage increase if you cut the range in half? It's obviously not going to double the amount you're
Right.
going to make.
And that's where it gets into it's kind of hairy because, like, for example, on Aperture, their user interface does not have an estimator yet. Maybe it never will. I don't know. But it's always based on trade volume. and how many other people are in the liquidity pool. So it's really hard to estimate. Now, some places, like if you go to a pancake swap, let me switch networks here. They'll sometimes give you like an estimation for your liquidity. So let me just pick one of these main farms here. Let's say I wanted to do, wait for this to load. Let's say I want to do USDT and BNB, okay? This is telling me, hey, your LP fee APR is going to be around 9%. That estimate is probably based around a really safe range. So I would say, okay, let me add liquidity. And then right here, they give me an estimated liquidity. Okay, so if I want to zoom out a little bit or let me pick one of their preset ranges. Here's a preset range. Oh, wow, that's not, no, this is being a little buggy right now. They're still ironing out some of there it is. Okay, so originally, remember, it said, hey, how about 8% or 7.9% or whatever on trading fees? But I'm going to pull this in to negative 5.5%, meaning it can't drop more than 5%, and it can't go up more than 5%, which is not super tight, but that's still a pretty tight range. Now it's estimating you're going to get about 77% APR on this particular pair, on this particular DEX, in this specific pool. So then if I wanted to participate in that, I don't have any USDT in my wallet right now, but I would say, okay, I want to put one BNB. And if I did one BNB, I would need 267 USDT, which my wallet does not have that right now. But if it did, there would be buttons here to say like, approve, confirm, whatever. And then it would create the liquidity for me. And then on Pancake Swap, it has like here's your position, and it tells you what's going on. So it does have a pretty nice user interface on that. And look, I can pull it in even narrower. And now they're saying with a narrow, now we're looking at 152% APR. But again, that's only if it doesn't fall out of that range. More than likely, BNB would, because if I view here, this is basically saying to get 278%, BNB has to stay between 301 and 310. That's a pretty tight window for BNB. I would imagine it would fluctuate much more than that. So you only get the 278% if it stays in that range the entire time. If it falls in and out of range, that 278% could become 50% or 80% or some other number, depending on how frequently you're collecting fees. Cool, Arshad, thanks. Oh, he already left.
So I guess what if you could check on it 10 times a day, what prevents you from setting that range really, really tight and then rebalancing all the time?
You could. Yeah, it would just be much higher maintenance. So if you want to, and again, then you're back to the old, like, if I'm a day trader, I can make money as a day trader, but I have to be at my screen 4 hours a day. And I would say if you're at like a hyper tight range, yeah, you're probably like, you don't have to be like glued to your screen, but you would probably be checking back like every 2 hours, depending on the volatility of that other asset or both assets, depending on what the pair is. If you're paired with a stable coin, you're just looking at the volatility of the one. And if there's a trend towards that one moving sideways pretty consistently, you go, great, let me just do that. That's one of the methods of making money in a bear market. You find an asset that's pretty much just moving sideways or sideways-ish. You pair it with a stable coin because a stable coin is stable, and then you just monitor it like crazy. And then, yeah, you can make pretty good money even in a bear market from a sideways moving asset just from the fees alone. So your liquidity position over the course of, let's say, 3 months, if you were going to do it that way, your base position is probably not going to change in value, but the advantage is you're gaining trading fees along the way.
Okay.
Cool. Well, I mean, we're coming up on the top of the hour, and you guys have my email. You can find me on social media. Steven, you have my cell phone number, so you guys can get a hold of me if you want to chat about anything else. Good session today. I'm probably gonna here and there do these impromptu sessions more often, just as I have time. Feel like it's a good way to reconnect with people who aren't in the mastermind and who maybe still have a few questions here and there. So yeah, if you're watching this on the replay, thanks for sticking with us until the very end, and just keep your eyes peeled for more emails and more posts on social media. Mostly Facebook is where I'm most present. We got the group, the Patient Investor, which is the freebie group on Facebook. And then you've got my personal profile. You can always just message me directly as well. I'm usually pretty active and responsive in there. So cool. Thanks, everyone. Have a good evening or morning, wherever you live. And I'll catch you later.
Thanks, you too.
Yep. See ya.